Hello guys, welcome to this video where I'm going to explain a workflow that I made that is called DeFi and Crypto Starter Kit. I originally made this content in Spanish and I do Spanish content mostly, but I thought in doing an English version of this video because I thought it can help someone who's just starting on DeFi and heard a lot about different protocols and different concepts, and it doesn't know exactly how everything is put together. So this video is mostly intended for people who know a little bit about DeFi and heard about some things, but it's also a big overall picture of what things you can do in DeFi and how you can interact with different protocols. So we're going to start. So I color coded this flow to represent the complexity level of some flows. So everything that you see on green is easy, on yellow is medium complex, and red is quite complex. Of course, everyone has different understandings on DeFi, and you might find that everything is green because they're very experienced, or someone else can find everything red because it's quite complex the first time they're hearing about this stuff. So it's just a personal view on how flows can get complex when you interact with different protocols in DeFi. So let's get started. And the entry point of our workflow is our DeFi user that asks himself or herself, how do I get started on DeFi? First, I would recommend to have installed MetaMask. MetaMask is a wallet that is installed as a Chrome extension, and then you can browse to a decentralized application like a DeFi app where you can interact with the app through the wallet, through MetaMask. So first of all, you will need MetaMask installed to interact with different DeFi protocols. And then the question that you might want to ask yourself is, what do I want to do? There's many things you can do in DeFi, but let's start from the beginning on the basic flow. So one thing that you could do is save on a stable coin. A stable coin is a cryptocurrency that its value is not volatile. It doesn't fluctuate. It's pegged one-on-one, usually with the American dollar. So if you have one currency, one token, the value is $1 American. So the next question that you need to ask yourself is, do I want a decentralized stablecoin? We are not going to enter in all the details of decentralized versus centralized, but you need to be aware that you can have centralized stablecoins or decentralized stablecoins. Centralized stablecoin means that there is a company behind that ensures that every token that they put in the market, they have an American dollar to back it. And you need to trust this company that is giving the correct information, that they have that money, and that they act on goodwill, if you will. And then you have a decentralized stablecoin. And decentralized stablecoin, the biggest and the most important project in the space is called MakerDAO, and the stablecoin name is called DAI. So one DAI equals $1, and there is two ways of getting DAI. You can mint DAI on MakerDAO. It means that you can create new coins by locking a collateral, and the other way is by just trading in the open market. So let's go again on the minting part. This means that you borrow money, but at the same time you are creating the money, right? And for that you need to put a collateral. You need to put another cryptocurrency, lock it there, and then you can borrow and create new money. And this is a huge stablecoin, one of the foundational stones, I will say, from DeFi. And then of course you have other cryptocurrencies which are centralized, and some of them are USDT, USDC, and True USD. And of course as well you can obtain them in the open market, so you can trade them, you can buy, sell, or whatever. And that leads us to the second option that we have, which is crypto trading, right? Buy and sell crypto assets. So again, you need to ask yourself, do I want a centralized exchange or a decentralized exchange? And this is a question that you are going to start asking yourself a lot when you start interacting with these protocols. And if you don't mind and you go to a centralized exchange, you need to bear in mind that two important things. One is that you will operate with an exchange with KYC rules, means know your customers, so you will have to give away your personal information to them and in order to become a customer. And the other thing is that you are not going to have full control of your money, because the wallet that you are going to put the money into, you don't control the private keys that control that money, that control those tokens. So I put this message here. It's like a common saying in the industry: not your keys, not your coins, right? So if you're going to operate with a centralized exchange, you have to bear in mind these two things: not your keys, not your coin, and you need to provide personal data. Some of the centralized exchange that you can find in the industry are Buenbit, which is an Argentinian exchange, Binance, which is the biggest centralized exchange nowadays, Coinbase, Kraken, and there's many others. And then, of course, if you want a decentralized exchange, it means that you will control your money all the time. You will be in charge of the private keys, and you don't have to provide any sort of data whatsoever. You will operate with a decentralized exchange, and the short for that is DEX. A DEX is a decentralized exchange, and I put some of the decentralized exchanges that exist in the industry here, and I classify them. So let's see first the protocols. Uniswap is the biggest decentralized exchange that exists in the industry today. Then you have Curve, which is very similar to Uniswap, but is mostly focused on stable coins. So you swap stable coins. Then you have Balancer, Kyber, SushiSwap, which is a fork of Uniswap. And then you have DYDX and Loopring. I made these two classifications because it's important to understand what an automated market maker is and what is an classical exchange. So you know how in normal exchanges you have an order book where you have selling orders and you have buying orders, and basically the exchange, what it does is just to match those orders and then infers a price of something based on those demand and supply, right? An automated market maker is a bit different because what it does is it relies on math on an algorithm to put the price of a trading pair based on the quantity that you want to swap, the quantity you want to change, and the amount of money that it's on that pair on the exchange. That is what you need to know for now. We're going to get back to this and explain a little bit further, because automated market makers, they need liquidity to operate. So you have, for one side, the people who are trading, who are making a swap. They have a coin and they want a different one, so they make a swap. And then you have other people who are the liquidity providers, the people who put liquidity, put the money into those sort of bags of money that can other people make the swap. So I will explain this a little bit further. And then you have a mix of order book and automated market makers like DYDX and Loopring. There's one more thing that you might want to ask yourself when you're trading on cryptocurrencies, and it is, do I want to trade synthetic assets? A synthetic asset is a token or an asset that follows the price of another asset, right? So you could have a synthetic of Bitcoin and so it is a token that follows the price of Bitcoin. You can have a synthetic of gold. It's a token that follows the price of gold. So you can have a synthetic of whatever you want actually, and it is more focused on like professional trading, or where you can trade whatever you want because you have a real representation of the price of that asset without having that asset, without actually physically having it. So it is a very interesting concept, and the best, or the most popular project of synthetics in the DeFi industry is called Synthetics, and I put it in red because it is a bit more complex in terms of you need to understand what is a synthetics, and there is a way where you can create your own synthetics by putting a collateral. So it is a bit more complex. That is why it's in red, and that is all you need to know about DEXs. And there's a lot, of course, but and we will probably will come back here to explain a little bit further some things. But then let's keep moving. And what do I want to do? Okay, we cover save on a stable coin and trade and crypto assets. And the next thing is invest in crypto and obtain a percentage of return, obtaining a yield. And this is the main question, right? That everyone's asking when they enter DeFi and they're in crypto. Okay, I want to invest in these protocols and somehow get some money. So there's quite a lot of stuff going on in DeFi, and this is not all, but I probably cover quite a few things. So let's start by one of the basics things that you can do, and is obtaining loans and lend money through these protocols, right? So again, as you can see, there is a pattern. Do I want a decentralized platform? If you don't want a decentralized platform, you can go again to a company where it has to conform with KYC rules, and again, not your keys, not your coins. You're giving away your money to a company, and you're trusting this company, and this company, you don't know exactly what it does, but to make a profit out of your money, and then you get a return on your money for that. You don't know what's gonna happen if that company, some regulation come and they ban this company for whatever reason. You need to trust. You are trusting the company that they will give your money back to you. So I mean, it is fine. These are really good companies. BlockFi, Celsius, Nexus, Salt, Swissport, they are really, really good companies. And I have some experience with some of them. So that is what you need to know about centralized platforms. And of course, if you want a decentralized platform, you will go to decentralized liquidity protocols, or what is called money markets. And I put here another question. Do I need a collateral? And I put this here because I want to explain another concept later. But basically, for most of the cases, especially if you are starting on DeFi, and if you want to take a loan, if you want to borrow money, you need a collateral. So these money markets, where you can loan and you can lend money, what they do is if you want to borrow money, you lock a collateral, and then you borrow money against that collateral. And if you want also, you can put some money into this protocol and earn some return, because that money is there and you're locking that money, right? Some of these protocols are Compound, DYDX, Cream Finance, Aave, BCTX. I put Maker here. Remember, Maker is the one that we talk about here, where you can create DAI, because it works really, really similar to a money market. The only difference is that with Maker, you are creating new money when you lock your collateral, and with the other protocols, you're basically borrowing from a pool that other people put money into. Okay, and that is like I would say 95% of the cases of a money market is that it's just borrowing and lending money on a decentralized way. And you need collaterals for borrowing. Now, there is a special case where you could actually borrow money without a collateral, and that is this flow that is called flash loans. A flash loan is a loan that you can ask without a collateral. You can take this loan without a collateral, but you need to pay back on the same Ethereum transaction. And it's quite crazy, the concept, but basically it means that you take the loan, you do something with that money. So you do some arbitrage, usually it's an arbitrage. So you go to another platform, trade some crypto and then sell it back, and you somehow did some profit, and then you repay the loan, the original loan, on the same Ethereum transaction. And it is quite interesting because it's safe, because if some of those steps fail, everything rolls back at the beginning, and there's no way that you end up in the middle of those steps with some debt that you cannot pay. So it is really interesting, but it's a tool that is intended for developers. There's no UI or there's no end user. There's no easy way for end users to start using. This is a set of APIs for developers to actually interact with these protocols. So basically, for doing flash loans, you have to code your own smart contract that interacts with these APIs. So it is a really interesting concept that I wanted to mention, but it's obviously in red because one of the most difficult things to do. Even if you know how to code those smart contracts, you need to find the arbitrage somehow, the arbitrage opportunities. Okay, so let's keep moving. And now we enter into more complex things, like I want to provide liquidity to an AMM and obtain the fees. An AMM is an automated market maker. We talked about this previously. So what does it mean that you want to provide liquidity? Well, it means that, as we talked before, all of these exchange, they are basically a bag of money that they sit on smart contracts, and each trading pair is a specific bag of money. And what happens is that people will put money into these bags in a proportional way, right? If, for example, you have ETH and DAI, some people will put 50% ETH, 50% DAI, and those people are called liquidity providers. And these people, they will get a fee for every trade that is made on that bag of money. And the trade is from other people who want to trade. Someone who has, for example, DAI and wants to trade it for it, they can go to that bag of money and do the trade, and the money that the trader gets is the money that the liquidity provider put. So the liquidity provider has an incentive of getting the fees of those transactions, right? So that is one thing that you can do in DeFi. You can provide liquidity to an automated market maker and make some money out of the fees. So I explain it here. By providing liquidity to a pair in an automated market maker, we get a share of the fees that are charged, which is proportionally to our participation in the pool. It means that if you put a lot of money on a pool, like if you own like 30% of that bag of money, you will get a 30% of all the fees of that trade is made. If you own 0.1%, you will get a few of those fees, you know. That is because, of course, someone who put more money contributed more to the liquidity. And that is, of course, the thing that you can do. And this is an interesting concept that you need to have very, very clear for other strategies in DeFi. And what I mean is that the original incentives for the people to provide liquidity to automated market makers and to other protocols were the fees and, of course, the returns that you get, for example, in a money market, right? If you put in compound, you put some money, you get a return, and that's your incentive. But a couple of months ago, we started seeing a new trend in DeFi that is called liquidity mining. And the project that started everything was Compound. And what Compound did is they wanted to reward the people who uses the protocol, right? So the people who locked money in the protocol and borrow against collateral in the protocol, they wanted to reward with a governance token, right? And what is a governance token? A governance token is a token that is used for voting on the governance module of the protocol. All of these protocols, they start as a foundation or more so like a company, and then they evolve. The main goal, or ideally, they evolve to a decentralized autonomous organization, which means that there is no central point of power, and the decisions around the future of the protocol, any change or any new feature, it is decided by the community by proposing new changes and voting on those changes. And the voting and the proposing, it is made through these governance tokens. So the idea is that the people who interact with the protocol, they now can decide what's the next step, what is the future of the protocol. For example, in Compound, if someone wants to include a new token for activating as a collateral, right? So you have a new token, you created a new token, and you want Compound to accept it. You can create a proposal in Compound, and the people can vote with the comp token. This is the token that Compound distributed to the users for voting on the platform. And that is how the project started to decentralize. Now, these tokens, they serve for voting and for proposing, but they are like any other token in terms of the market. They are subject to speculation. So basically, you can buy and sell comp if you want, or any governance token for that matter. So that is a new incentive that appears now into the liquidity providers, right? The incentive is that you can use a protocol, or you can provide liquidity to an automated market maker and get a governance token that you can use for voting, for influencing the protocol, or for selling it in the market. So that is what is called liquidity mining. And so you can see liquidity mining, of course, you get the fees, but at the same time, the arrow goes here. Okay, so this is another thing. When you provide liquidity, you also receive a liquidity provider token, which basically means it is the proof that you provide the liquidity to certain pool. This is the way you can prove. You get a token that represents the share of the pool that you have, right? So there's different ways of doing liquidity mining, and some protocols have different ways of interacting and rewarding the community. For example, in Compound, Compound distributes tokens on a certain basis to the users that use the protocol, right? For example, in Uniswap, they recently launched their own governance token called Uni, and what they did is they did an initial launch where what is called like an airdrop. They rewarded all the people who interacted with the protocol with Uni tokens. So there was an initial airdrop of those tokens to the people, and then what they did is they provided a liquidity mining program, and this is something that a few other protocols do as well. It is a liquidity mining program, means that you can grab these liquidity provider tokens that you get for providing liquidity to an automated market maker, say like Uniswap or Curve. So you provide liquidity to this bag of money, and in exchange you get these liquidity provider tokens that proof that you put liquidity in those specific trading pairs, and it's also a proof that you are supporting the project, right? It is a proof that you put liquidity in the market for the project, you're supporting them. So some protocols has a module where you can stake those liquidity provider tokens, which means that you can lock those liquidity provider tokens and say, look, I have provided liquidity in this platform to this trading part, to this cryptocurrency, because I support, because I want to get the fees or whatever. And then you put those tokens on these modules, and these modules, what they do is they reward you with governance tokens, right? So it is sort of a 3-step. You provide liquidity, you get those liquidity provider tokens, and then you go to the platform and then you stake those liquidity provider tokens. At the same time, you get those governance tokens, and that is what it is called farming. This is farming a governance token or farming something in DeFi. It means that you are somehow locking some sort of token and getting a reward based on that lock or that stake. So that's how usually you get governance tokens. Each project has some difference, but that's basically how it is. Some projects you don't need to stake liquidity provider tokens. You just stake the same governance token and you get more governance token and more rewards. So I put some examples here just for you to understand a little bit. Like Comp is from Compound, YF is from Yarn Finance, Uniswap, Val is from Balancer, CRV is from Curve. And what can you do with this governance token? Well, there's a few things that you can do. So you can participate in the governance of the protocol by voting and proposing changes, of course. You can sell it in the open market, and you can use to provide it to a liquidity pool again. So if you can sell it in the open market, think about this. So if you can sell it, it means that there's people who are willing to buy, and there's people who are willing to buy that want to use a decentralized exchange. So they want to come to Uniswap. So then there's a need for a liquidity provider that provides a pair that is, for example, YF ETH or something, right? So you can actually go again and provide liquidity to some of these bags of money. Or you can, of course, stake to get the rewards. In some cases, you just stake it and you get more and more of this governance token. So as you can see, this is what is called a money Lego. DeFi is a set of protocols and platforms that they interact with each other, and it is called a money Lego because you can start doing a lot of things. There's a lot of composability in all of these protocols. And of course it gets quite complex. I know this is quite a lot. If you never hear about DeFi or liquidity providers, it's quite a lot, but I think it's good to mention it. And it's not like if you enter into DeFi and crypto you're going to start doing this. You're probably going to start saying a stable coin, understanding decentralized exchange, using some money market, and then you start getting into more complex things, right? So the next thing that we need to ask when we think on investing in a crypto and obtaining a percentage return is, do I want automated investment strategies? And what is that? Well, all that we talk about here, about providing liquidity, going to a money market here, and maybe like locking some money here, and then getting the token and staking it and doing all sort of stuff. There's some platforms that they do it automatically for you with the smart contracts, and they have what it calls oracles, where they can check the price of different protocols and move the money automatically without you having to do it manually. And also you have other platforms where they do that, and also they do what is called algorithmic trading, but basically bots that they have a strategy for trading and they trade in the market, and if they made a profit, you get a share of that profit because you invested on that trading bot. So I put those two projects here because they are a bit different but sort of the same. One is called Yarn Finance, is one of the most popular projects in the DeFi space and one of the riskier, I will say, and token sets. So Yarn Finance has a few products. One of them, couple of them are Y-Vaults, Y-Earn, and Y-Insure. So basically Y-Earn is a sort of a robot or a bot where you put some money and then the bot just searches for the highest yield for the platform with the highest yield. This platform have dynamic returns on investment based on the utilization ratio of those pools and the prices of the cryptocurrencies. So it's not like you have a fixed percentage of return on this on the specific on the money markets on Aave, Compound, DYDX, and Y-Earn does that automatically. So you put money in Y-Earn and Y-Earn automatically knows which one has the highest yield and moves the money there, and then if it changes it will move the money to other platform. And Y-Vaults are a little bit more complex because they have specific strategies. It's a vault of money that you can invest in, and the vault has a strategy that is voted by the community, and it's a yield farming strategy. A yield farming means that it can go and do whatever. I mean, whatever makes sense to have a high yield, high return, right? It can go and lend some money in Aave, and then with those tokens they made a swap in Uniswap, and then they sell it or they stake it for other tokens. So it can be whatever interaction between protocols that makes sense to have a high return. And then Y-Insure is more focused on financial insurance. And then you have, I think, other big project which is Token Set, and this project has some yield farming strategies as well, but it started as a algorithmic trading platform where people put these trading strategies, these trading bots to execute, and you can put money on those bots and you can get a return on the returns that the bot made by trading. And recently Token Sets also launched their own index. It's a collaboration with DeFi Pools. If you don't know what these DeFi Pools, you should check it out. The webpage is a page where there is a ranking of the DeFi projects and how much money is locked, and a bunch of information about the DeFi industry. And so there is a ranking of the top 10 DeFi projects by money locked, I think. So DeFi Pulse Index is an index of the top 10 projects. So it is a good way to have exposure to the top 10 projects without going and buying each one of them, right? So you buy a little bit of this index. It's like sort of an ETF of the financial markets, but for crypto DeFi projects. So, and of course has a weight. A weight means that there is the distribution of those top 10 tokens. There is 30% maker and 10% compound, whatever, and every certain number of days the index get rebalanced, and the weight changes a little bit. But there's another interesting product that Token Set had. And of course, I put here that a few of the Yarn finance and token strategies include the staking of the tokens, right? So as you can see, this is a way more riskier because basically if they are interacting with every other platform and protocol in DeFi. So if something fails, it's likely that you may lose money or something goes not as expected. So you need to be very aware that these two projects, especially Yarn Finance, are a really good project, really interesting, very good returns, but very high risk as well. So interesting. And okay, so there's one more thing that we can do as a DeFi user, and it is participating in the governance of a decentralized protocol. We already touched on this. So basically you need to ask yourself, do I own any governance token like Wi-Fi, Comp, or Uni, or whatever? And if you don't, you can obtain it by liquidity mining or yield farming, or by trading in the market. You can go and buy these tokens. And if you have these tokens, you basically go to the part of the protocol where is the DAO, the decentralized autonomous organization, and there is the governance module. And I put here some of the examples of the tokens and the projects. Like Comp is from Compound, Aave Lend is from Aave, Wi-Fi is Yarn Finance, Uni is Uniswap, CRV is Curve, and MKR is Maker. So all in all is a lot. I know there is a lot to take, especially if you don't know about DeFi and you're seeing this for the first time. But you need to understand that this is a step-by-step process, and when you enter to DeFi, you usually enter on a stable coin just to be sure that you're not losing money. And then you need to understand a little bit further what a decentralized exchange and the money markets like loans and lending. Once you understand this part and this part, then you can move to understanding a little bit more about yield farming and liquidity mining and all the stuff, all that good names that the people in the industry put to the things that you can do. So I hope you like this video. Just tell me in the comments if you enjoy, if you understood, or if it was too complex. It is a lot, and it's a very, very big picture of everything that you can do on DeFi. There's more, but this is the basics. So all right, yeah, I'll see you next time. Maybe I'll continue doing some English content, who knows. Let me know your thoughts, and I'll see you next time.